Over 1,000 tons of gold. That's how much central banks bought in 2024, the third consecutive year above that threshold. But here's what caught my attention. They're not just buying gold. Many are actively reducing dollar holdings. China officially added 44 tons while continuing to reduce U.S. Treasury holdings. This isn't simple portfolio rebalancing, this is strategic repositioning. In the next 12 minutes, I'll show you using central bank data what appears to be one of the most significant shifts in monetary reserves in decades. And if this trend accelerates, we're not just talking about currency adjustments. We could be looking at a fundamental restructuring of the global monetary system. I'm not a financial advisor. This isn't financial advice. This is geopolitical analysis based on official central bank reserves data. Let me start with the numbers. According to the World Gold Council, central banks purchased approximately 1,045 tons of gold in 2024. This follows 2022's record of 1,136 tons, the highest since 1967, and another 1,050 tons in 2023. That's 3 consecutive years above 1,000 tons. The previous decade averaged just 473 tons annually. This is not normal buying behavior. But here's what's particularly notable. This wasn't driven primarily by traditional gold holders like Germany or Switzerland. This was driven largely by countries seeking alternatives to dollar-dominated financial systems. Poland led all buyers in 2024, adding 90 tons to its reserves. Turkey followed with 75 tons. India acquired 73 tons. China officially reported 44 tons, though analysts estimate actual accumulation could be significantly higher when including unreported purchases. Combined, these emerging market central banks are accumulating gold at a pace unseen in modern history. But here's what makes this different from previous gold accumulation cycles. These aren't speculative buyers seeking short-term profits. These are sovereign nations with combined populations exceeding 3 billion people systematically building alternatives to complete dependence on the US dollar-based financial system. This story doesn't start in 2024, it starts in 2008, with a decision that would reshape global monetary dynamics. When Lehman Brothers collapsed, the Federal Reserve responded with quantitative easing. They created trillions of dollars to buy government debt. Other central banks watched carefully. They saw America print money to address its problems while the rest of the world absorbed the consequences. They watched dollar weaponization through sanctions systems. They watched the U.S. freeze Russian central bank reserves in 2022. That action proved something crucial. Dollar reserves aren't fully controlled by the countries holding them. 2022 marked a turning point. Russia's exclusion from SWIFT demonstrated that the dollar-based system isn't neutral financial infrastructure. Countries realized their treasury holdings could be frozen, confiscated, or restricted at Washington's discretion, so they began building alternatives. BRICS payment systems, currency swap agreements, direct trade settlement in local currencies, and most importantly, massive gold accumulation to back these alternative systems. Let me show you the data that suggests this isn't temporary rebalancing. This appears to be permanent structural change. China's official gold reserves, approximately 2,280 tons as of late 2024, but their domestic gold production adds 330 tons annually. Gold imports through Hong Kong add another 200 plus tons. Where's all this gold going? Strategic reserves. Some analysts believe China may hold over 5,000 tons when including unreported purchases. We can't verify this independently, but the accumulation trend is undeniable. Russia's response to sanctions increased gold reserves to 2,330 tons while reducing dollar holdings to near zero. They've demonstrated a major economy can function outside the dollar system. Energy exports settled in rubles, yuan, and other currencies. Gold backing provides credibility for non-dollar trade arrangements. But here's where it gets really interesting. The BRICS expansion brought the alliance to significant portions of global population and GDP. These aren't developing countries begging for dollar access. These are economic powers building systematic alternatives. The dollar's share of global foreign exchange reserves has declined from 71% in 2000 to approximately 58% today, according to IMF data. That's a 13 percentage point decline over 2 decades. Not a collapse, but a clear and persistent trend. Some of this reflects diversification into euros, yen, and other currencies. But gold is playing an increasingly important role. Central banks now hold roughly 1/5 of all the gold ever mined. That percentage has been rising steadily. Here's what Western financial media doesn't always emphasize. The infrastructure for dollar alternatives is being built. China-Russia trade, over 90% settled in yuan and rubles. India exploring rupee settlements with various partners. UAE testing local currency mechanisms. The dollar's role as global reserve currency rested on two pillars: oil priced in dollars and lack of credible alternatives. Both pillars are showing stress. Saudi Arabia has signaled openness to accepting currencies beyond dollars for oil sales. This doesn't mean the dollar is collapsing. It remains dominant, but the monopoly is weakening. Central banks understand monetary history. Every reserve currency eventually evolves or is replaced. The British pound dominated global trade for 2 centuries before losing reserve status after World War II. The dollar has held reserve status for 80 years. Historical patterns suggest transitions are inevitable, though timing is unpredictable. Unlike previous transitions that happened gradually over decades, modern financial systems can move faster. When confidence shifts, it can shift quickly. And the indicators suggest confidence is diversifying. U.S. Treasury auctions facing changing demand dynamics. Foreign central bank holdings of treasuries fluctuating. The dollar's share of global reserves declining persistently. These aren't crisis indicators, but they are structural shifts. The current gold accumulation reflects central bank understanding that the next monetary system may require real backing. Countries stockpiling gold now are positioning for a world where currency values derive from multiple sources of credibility. Germany repatriated 674 tons of gold between 2013 and 2017, 300 tons from New York, 374 tons from Paris. The Bundesbank cited a desire to store half of reserves domestically. They completed the transfer 3 years ahead of schedule. The Netherlands repatriated gold. Poland repatriated gold. Hungary repatriated gold. These aren't coincidental moves. These are strategic preparations by nations seeking greater monetary independence. European positioning is particularly significant. The European Union represents major portions of global GDP and trade. If Europe continues building financial alternatives alongside Asia, the dollar's monopoly becomes harder to maintain. Recent EU initiatives suggest this shift is already underway. European payment systems exploring independence from dollar infrastructure. The European Central Bank's digital euro project is actively developing. Trade settlements in euros and yuan are increasing. The Federal Reserve faces complex choices. Rate decisions affect both domestic economy and global dollar demand. Meanwhile, gold accumulating central banks face different calculations. Their currencies gain credibility through diversification. They are positioned to benefit from a more multipolar monetary system. Let me be clear about what I'm not saying. I'm not predicting the dollar will collapse next year or even next decade. I'm not claiming the paper financial system will fail imminently. I'm not telling you to buy gold. That's not advice I'm qualified to give. What I am saying is this: every indicator that preceded previous monetary system transitions is now present. Persistent reserve diversification away from the dominant currency. Physical asset accumulation by major economic powers. Alternative payment infrastructure being built and tested. Geopolitical fragmentation accelerating financial separation. And here's what makes gold different from other assets in this context. Gold isn't just industrial, it's historically monetary. It provides credibility for alternative currency arrangements. It can't be printed. It can't be frozen through sanctions. It can't be debased by monetary policy decisions. That's why central banks are accumulating it at this pace. Not for investment returns, for monetary insurance. Here's what I'm watching. You can watch the same data, all publicly available. IMF COFR data on reserve currency composition. World Gold Council reports on central bank purchases. SWIFT transaction data on currency usage. If dollar share continues declining below 55%, that signals accelerating diversification. If gold share of reserves continues rising, that confirms the trend. If BRICS payment alternatives gain significant transaction volume, that represents real infrastructure, not just rhetoric. 3 consecutive years of central bank gold purchases exceeding 1,000 tons. That's not a normal market pattern. Dollar reserve share at 58%. down from 71%. That's a clear directional trend over 2 decades. Multiple countries repatriating gold from foreign vaults. That's a statement about trust and control. Alternative payment systems being developed by major economies. That's infrastructure for a different future. You can call these unrelated developments, market noise, normal fluctuations, or you can recognize a pattern forming. I don't know exactly what happens next, neither does anyone claiming certainty. But I know what central banks are doing with their reserves. I know what that has meant historically. And I know which side of that pattern I'd rather understand. The question isn't whether I'm right about timing. The question is, are you paying attention to what central banks are telling us with their actions? Over 1,000 tons of gold purchased, for the third consecutive year, by institutions whose job is preserving monetary stability. That's not speculation, that's preparation. The preparation has already begun. This content is for informational and educational purposes only. It does not constitute investment advice or a recommendation to buy or sell any security, commodity, or financial instrument. Historical patterns do not guarantee future results. Central bank behavior can change. Currency markets are highly volatile and unpredictable. The creator is not a registered investment advisor. No fiduciary relationship is created. Investing involves substantial risk, including potential loss of principal. Past performance is not indicative of future results. The dollar remains the world's dominant reserve currency. Consult qualified financial professionals before making any investment decisions.